Hi, I'm Kavan, founder of Nueconomy. This is our second installment in our Counterfactuals series, exploring the pivotal moments that could have reshaped our economic world entirely. Today's thought experiment: what if the world's biggest savers had been spendthrifts instead? Every morning, your economic reality has been predetermined by decisions made in distant living rooms and boardrooms. A German pensioner meticulously preserves her savings. Chinese households bank half their income. Saudi sovereign wealth funds are deploying petrodollars across global markets. These aren't merely personal financial choices, they constitute the invisible architecture upon which our interconnected economy rests. Consider the counterfactual: a world where Germany prioritized consumption over export surpluses, where Chinese families embraced immediate gratification, and where oil rich nations spent their windfalls on domestic consumption rather than accumulating massive sovereign wealth funds. This wouldn't simply mean fewer BMWs in American driveways or reduced Chinese electronics on retail shelves. It would fundamentally rewrite the economics of the past 4 decades. Begin with mortgages in deficit economies such as the United States, those historically low interest rates that defined the post 2008 era. In our alternative timeline, American borrowers would face 7% or 8% as standard, absent the rivers of foreign capital that artificially depressed borrowing costs across Western markets. Retail economics would be transformed entirely. The $15 shirt, the $499 television in American stores, these price points existed because distant savers were willing to defer consumption while financing Western spending habits. Without this circular flow of savings recycled through debt markets, consumer prices would reflect the actual cost of production and capital. Employment patterns tell a more complex story. Without the systematic migration of manufacturing to surplus economies, millions of industrial jobs would never have departed developed economies. Wages might indeed be higher in countries like the United States and Britain, yet purchasing power would face offsetting pressures from elevated consumer prices. Financial markets would bear little resemblance to the landscape of today. The 2008 crisis was fundamentally a product of the global savings glut, excess capital desperately seeking yield, driving investors toward increasingly exotic instruments. Without trillions in surplus savings distorting risk assessment, finance would claim a considerably smaller share of economic activity. Geopolitically, China's remarkable ascent was predicated on a specific growth model, suppressing domestic consumption, maximizing production, and exporting the surplus. In our counterfactual scenario, this rise proceeds at a more pedestrian pace. American hegemony might have endured decades longer without the economic challenger that savings driven growth ultimately created. Perhaps most significantly, the financial instability that has characterized modern capitalism would be largely absent. Without persistent savings imbalances creating dangerous asset price distortions, systemic crises become far less probable. This alternative world wouldn't necessarily represent an improvement. Global poverty reduction might have proceeded more gradually without China's export led manufacturing boom. Innovation could have suffered without the scale advantages that global supply chains enabled. Yet, as we confront contemporary challenges, widening inequality, supply chain vulnerabilities, and mounting geopolitical tensions, this counterfactual illuminates a fundamental question. Have the savings imbalances that constructed our interconnected world outlived their economic utility? The modern global economy was constructed on structural imbalance, persistent surplus and deficit countries locked in a complex dance of production and consumption. Perhaps the most transformative policy innovation wouldn't involve reshoring or decoupling, but achieving equilibrium between saving and spending within and across national boundaries. For 4 decades, we've inhabited an economically efficient but inherently unstable world. The choices made in boardrooms and living rooms across surplus economies continue to shape daily economic realities in deficit nations in ways that remain largely invisible, yet profoundly consequential.